Sure. Which we appreciate.
It's the same presentation I
Yes.
saw yesterday.
Perfect decision. Turn off my phone. Yeah.
Your assistant. Sorry today.
No,
Costco
really.
at lunch. Are we ready to go? Or not?
Showed up to Aldi today at 8:38, thinking I was gonna be. Shit.
Did it open today?
Yeah,
Oh, really?
it's like hundreds of people in line camping out.
Oh, really?
Yeah.
Yeah, and Marla said to me, I guess you didn't want to go. I said, I don't look at the coupons on the table.
Can't imagine the welcome package was that good.
Friend of mine, $100.
What did it?
Yeah.
Got the gift card?
Yeah.
It's-
Oh, $100 gift card for the first 100 people?
Yeah.
You must have snuck in on the side door. That's You were smart. Oh, I'm sure. Sort of like Black Friday, right? Oh. That's why I don't go to Black Friday. I'm scared.
$100 at Aldi will go a long way.
All right, shall we start?
Yes.
Oh, good. Okay. All right, so welcome to the
First meeting 25.
first meeting of 2025. Yes, thank you, Alan. All right, let's approve the minutes. Do I have a motion to approve the minutes? We do, Mike.
Second.
Okay.
No, Shannon seconded it.
Okay. I got it.
Any changes or modifications or comments? All in favor?
Aye.
Any opposed? Excellent. All right. Motion, minutes been approved. So now we go to Tom and Jonathan. Please.
Good evening. So we have performance to the end of year. So obviously fourth quarter. Jonathan's gonna run through the impact on the portfolio. If you've looked at the back, we have a couple other thoughts on kind of where we go from here. Some conversations that we've had the past couple of years, real estate, private equity, just overall things. So there's likely some room for us to continue that conversation in the journey, I guess, that we've kind of been on. So we'll get to that, but I'll let Jonathan talk about the portfolio.
Thanks, Tom. So you all can go ahead and flip to exhibit 1. We'll skip the market environment as usual. And what we have here today is your fourth quarter report. Everything is pretty much up to date except the Partners Group investment that's still lagged by about a month. We don't have the December statement yet. So you flip ahead to, I believe, page 4 and 5. You have your market value page here. So you have all your asset class composites, the underlying investments, what asset class they correspond to, beginning market value as of the beginning of fourth quarter, net cash flows in and out for investments through that period, ending market value as of 12/31, and then you have, it's called percent of portfolio, but it's just the current weighting as at the end of the quarter for the investments and the composites, and then that's compared to the right column there, policy percent, which is your target weightings for all those asset classes and the underlying investments. And overall, as you go down the page, you see that you're pretty close to targets in most cases, a little under for fixed income. That's because you pay benefits out of there, a little over for US equities because they ran for the most part. And then on page 5, you do see we are under on real estate and over on private equity. That's kind of what Tom's going to get into here in a bit. But I did want to bring attention to the real estate investment, principal real estate. We did get about a little over $500,000 out of that investment during the fourth quarter. So the gates kind of opened up a bit in the fourth quarter, thankfully, for those redemptions. And currently have about 284,000 left in the redemption queue there out of the initial 1 million that we had requested. So made quite a bit of progress there. But again, Tom will talk about that more here in a bit. Go ahead and flip with me to page 8. I just want to spend a moment here, just since it's the end of the year. Looking at that second column from the left, it's the 1-year column, kind of just shows you your journey throughout the year. So you start out the year with just under $22 million, had negative cash flow out of just under 1.1 million, but you had positive investment gains of just under 2.1 million. And that's how we arrive at that ending market value of just under $23 million for 2024. Yeah, that same information going out to the right for different time frames. And you see that in most cases, the investment gains have typically more than made up for those negative cash flows. I'm going to skip a few more pages here. A lot of this is repeated on pages 12 through 14, I believe. So on page 12, we'll start with the top line there. It's your total fund composite. And overall, pretty good year, just under the benchmark for the quarter and just under the benchmark for 1 year. You had a return for 2024 of 9.8%, just 2.2% behind the benchmark of 10%. And again, same information kind of going out for varying time frames. You were in line for 3 years and 5 years, matching your benchmark, I should say. 7 years a little bit behind, 10 years a little bit ahead, and then since inception, we are lagging the benchmark there. And then underneath the benchmark return, you have rankings. 1 would be the best, top first percentile in the universe, and then 100 would be the worst, the bottom 100th of the universe. And then looking at the underlying here, we have the different asset class composites. I'll start with fixed income, of course. Fixed income composite has done really well. You have some more high octane kickers in there, rather than your core managers that a lot of people like to stick with. High yield and Aristotle, principal high yield and Aristotle, I should say. They, even though they were behind their benchmarks for most time frames, they have added quite a bit of alpha compared to the benchmark for the total fund there. So that's why you see that outperformance on the top line for your fixed income composite. Thankfully, they were there because fourth quarter was not great for fixed income as rates rose on the long end of the curve due to fears of inflation resurgence and the deficit of the government. Then on page 13, we have your U.S. equity composite and the underlying investments there. Overall, pretty good year. You're up 20.8%, still behind the benchmark, unfortunately, though. Probably would not expect another 20+% return for U.S. equities this year, but you know, stranger things have happened. Unfortunately, that tilt to mid cap and small cap has drug us down a bit compared to that all cap benchmark that we have, the Russell 3000. The thesis is that, you know, you go into more riskier investments, smaller capitalization and mid capitalization stocks should have a higher return, but that's not really been the case the last few years, especially with rates being high. Next on page 14, on the top line there, we have your non-US equity composite. Actually a good story here for the quarter and for the year. You were ahead for those time frames. Mostly lagging, going back in time, unfortunately. But the underlying did pretty good for the quarter. They at least either matched their benchmark or were ahead. It's kind of tough for these international equity international equity mutual fund indexes to really keep up. It's such a wide universe and things move so quickly sometimes there. Typically, that's why you do see a lagging or tracking error there for those indexes. But emerging markets has done pretty good, at least from a universe perspective, typically ranked in the top third or so of their of its universe, and pretty 1% ahead for the quarter. Then real estate, you have your principal U.S. property fund there, typically ahead for most timeframes. It did lag for the quarter, year, and 3 years, but overall positive for most timeframes. And thankfully, it looks like maybe we might have seen a bottom as of the end of the quarter. So hopefully we continue to see positive returns after a few rough years there in real estate. And then private equity, this is the much newer addition to your portfolio. Partners Group, which was added in February 2022. So we're coming up on 3 years here this month. Overall, that's done pretty well. A little bit behind the benchmark for the year. We don't have the return as of fourth quarter fully for the benchmark or the fund. But as you go back in time since inception, it's pretty handily ahead of its benchmark, 6.2% versus 0.6% for the benchmark going back to February 2022. That'll do it for performance. I'll finish up on page 21. And this looks at the fees that you're paying all these managers. So what this page shows is all your managers, what their expense ratio is or their fee schedule is. And what we do is we put that into dollar terms, estimate an annual fee you're paying them per year. And then we break that down into an expense ratio and then compare it to the industry median for other managers in that asset class that they're managing to. And what we do is we total all that up on the very bottom, not the very bottom blue line, but the second, the bottom darker blue line. So we're estimating as of market values, as of the end of the year, you're paying about $86,777 annually to these managers. And that equates to an expense ratio of 38 basis points, just under 0.4%. And that is just a little bit higher than the industry median of 35 basis points. And unless there's any questions, that's all I had on the fourth quarter report. I'll go ahead and hand it over to Tom to look at Exhibit 2, which dives more into the private equity and real estate discussion that he foreshadowed.
I have one question.
Mhm.
Oh, I'm not on it. I have one question. On page 11. I know we delayed these meetings, for the month after the quarter ends. Why don't we get 2024 numbers on there?
So it's an issue with the reporting system.
Uh-huh.
Because it just ended. What you have to look at is actually on page, well, at the top line there. So page 9, that 1 year time frame, it's the fourth column or kind of in the middle.
Mhm.
9.8% was your return for 2024. So if we wanted to attach a year to that one, it would say 2024, but the system just kind of doesn't let us get around it. So if we generate a report as of the end of January, then it would show up on that page you were referencing, page 11.
Sounds crazy.
I
No,
know.
I understand.
Yeah.
Because
It's
part
not-
of the partners group, because
Yeah.
this partners group isn't closed out or
No, that's not the
That's
reason.
another new.
It's
It's just your software.
Mhm.
Like you have the data in there.
Right.
clearly for 2024.
Right,
It's just crazy.
okay.
It's.
I know you guys don't write the software and
Yeah.
don't buy the software.
We were talking about this actually. I was thinking about adding a year-to-date number there, which technically would be the exact same as that 1 year return we have on page 9.
Mhm.
So I'll go ahead and add that
But
just
that would
so
be-
we have it.
Gonna be.
It would be
Year-to-date.
updating every if we did it as of March, it would be just for the first 3 months of the year. So, yeah, it's goofy.
But, yeah, bottom line, 9.8% for the.
Mhm.
So Exhibit 2 kind of talks a little bit about some of the things that that the board's discussed, in the past couple of years, as well as kind of some longer term thoughts that that we've had with you. I'll wait till Jennifer gets there. Now you gotta get through all the fun stuff.
Yeah. The stuff that'll put you to sleep.
Let's do that. We'll bookmark. I have these bookmark these. Yes. So discussion points, that's perfect right there. So just kind of a reminder, we streamlined the US equity allocation long ago, ancient history. You had different managers doing different style boxes. They would underperform. You would fire them. You would hire a index funds. He kind of had this hodgepodge of index funds. So we streamlined it into just mid cap and small cap. And you also shifted the small cap to the S&P 600 mandate, which historically has done better, and this year also proved out that way as well. And you eliminated preferred stock from your allocation. So it's kind of somewhat recent history. Put in a couple rounds of redemptions for real estate. And as Jonathan mentioned, the market is starting to heal in the real estate market. Obviously, there's different pockets that are still stressed, and obviously office is still one of them, and we expect there to be obviously some continued pain there. But at the end of the day, the real estate is 7.5% of the portfolio. Your target is 10%. And when we talked a couple meetings ago about thinking kind of bigger picture, kind of round numbers, that was actually kind of one of the thresholds of the allocation that we talked about, of maybe maybe 7.5% is the right number, maybe it's 5, whatever it is, but that was actually, so coincidentally, it's right now at 7.5%. We didn't get to say how much to take back, but that's how it worked out. You still have another 285,000 in the exit queue for that. So if you don't rescind that, and you're able to rescind. If you don't rescind that and that money starts coming back, that's going to put you at a little over 5% in real estate. So where that all kind of sits there, and your real estate minimum based on your guidelines is 5%. So you'd be extremely close to kind of the bottom end of that. Your cushion, as you'll see, I have a bunch of different scenarios I have in here, as well as I've mocked up a bunch of others outside of this. Is your cushion is pretty healthy right now. But if you want to do any kind of major overhauling, move a bunch of fixed income out, all that, like you're not there yet. So you still have to kind of work within the constraints of the cushion you have. And I just put a little note on there, you know, the core fixed income, the core plus real estate, it really hurt you guys too much. But there, you know, if we had a choice on a couple of those, we would look elsewhere. One thing I didn't mention in that little list there was high yield. That's one where it's kind of through the years, we've said we kind of knocked dominoes down. Maybe that's a place where we can look elsewhere for your high yield. So portfolio thoughts for today, within the constraints of your current asset allocation / investment policy. You could look at keeping your real estate at that 7.5%, which has come down, and look at bumping up your private equity to 7.5%. 7.5, 7.5 on there. You are already overweight. Jonathan mentioned you are already overweight private equity, so this wouldn't be a full top up from 5 to 7.5. You'll see on there, but we have a little portfolio background on that as well. And then number 2, just kind of thinking ahead. If you'd be interested in authorizing us to perform a high yield mutual fund search at, say, the next meeting, we can look at possibly legging into another high yield fund outside of Principal, have that held in custody at Regions. We know a lot of options out there, and like I said, probably some things you might prefer if you had the choice. So what would that do to you? What would be the impact to that from a cushion standpoint? I have that behind here so we can talk about that.
When you say if the real estate allocation went down to 5, you say it's at the bottom part. So the IPS range from 5 to 15. So if market performance in real estate dives and it drops below 5, what does that mean from a compliance standpoint?
That means you're out of compliance.
So do you have to buy immediately, or what does that?
I mean, you really can't on that. I mean, does it happen occasionally in portfolios? I've seen extreme events we've all lived through. Yes.
Well, let me interrupt real fast. If we change the allocation of real estate to 5%, we're going to change the bands.
But I don't think that's what he's.
Then you would need to, yeah.
We would definitely have to change the
Yeah,
bands. There's no way you
That would
could
be a
say.
0. Yeah, 0 would be your minimum, or 1%.
Yeah, correct.
Yeah.
You would definitely have to
So I
go
have
like
two-
from 0 to 10, or like 2 to 8 or something like that.
Yeah, so if you just turn to page 3, kind of big picture here. And this is what we ran similar last year when we kind of started thinking through kind of next steps. Your current portfolio, average annualized 10-year expected return, that's that in the box below, 7.58%. Expected volatility throughout that time period, 10.07, and then that number beneath that is just return divided by volatility there, kind of utility. Portfolio A, try to color code it. That's just going from 10 to 7.5, basically working within your current investment policy. 7.5, 7.5. That bumps up your return a little bit, and your volatility does go up as well. Just your private equity is going to be more volatile than just real estate from a expectation standpoint. Your return over volatility stays the same, and then B is kind of the flipping kind of your alternative targets here, because you have 10% real estate, 5% private equity, and basically flip-flopping that. You see the return goes up a little bit more, volatility goes up as well. Your utility does go down a little bit, but your expectations are some higher returns from this portfolio. And then my little footnote on there, to the chairman's point, portfolio B would require investment policy change and getting that through, through council. Some other things that we have talked about but are not included in here, we talked about private credit. Right now, with you being less than 25 million in assets, that kind of limits options from new funds that you can get into. So there are other products that are coming along. BDCs, I believe, is kind of one vehicle that where you could start to use private credit or even private equity less than 25 million. But it's still kind of, I would say, new to a point right now. So this is kind of us looking at what you have going on right now, conversations that you've had. I will stop talking and let you all give me your thoughts.
Anybody want to start?
I mean, it seems like 7.5 of each would not require an IPS change because that's well within the bands.
It's I kind of view it as like a half step that doesn't require lots of overhaul.
Go ahead. You finish.
No, in my experience, I think we talked about this, but the private equity is gonna continue to creep up. So I don't know if you're proposing adding more private equity or just letting it kind of organically grow.
We will propose in the next area a modest increase just to kind of bump that up. Because you do exhibit 3 are the different scenarios, the 3 high-level different scenarios, and the usual kind of rebalancing that you see that goes in there. The blue one that I color coded there, that's saying, no, we like our targets for now. You still got to raise money to pay benefits, and you have excess cash now because of the redemptions that you've received. So it's 2 things going on there. You need to rebalance and then put that cash to work. And you still have that redemption out there from real estate. So we need to make a decision.
Yeah, so the first thing is we had talked about going down to 5% real estate.
Yes.
And I don't think we should change our mind because we have to do a couple extra steps. I think that's being foolish and, taking the easy way out. And the easy way out is usually not the smart way.
Sure.
That should, again,
It's the same for,
I know,
either way,
I'm
it's the
not- I'm
same
not-
for us.
yeah, no, I know. I'm just giving my opinion here. That's number one. Number two, as far as the private equity,
Mhm.
I know I forgot, what did we replace the preferreds with private equity? What was the private equity?
Gonna grab it from a few different places. Preferred was a big part of that. There was some different moving parts, but preferred was a big.
And what is it in place? I mean, as far as what are we putting it, I know it's different and I understand private equity,
Yeah.
but what are we, I mean, I guess we need to say, what is our private equity where are we taking it from to get to private equity? Is it going to be all real estate where we go 10% private equity and 5% real estate? Because for 2 things. Number one, I mean, over the last 3 years, the private equity, I don't know, yes, compared to your benchmark, it's done great, but
It's been a quiet period.
it's been very quiet. So
100%.
that's one thing that is, I mean, in 3 years is a small time frame, but
Sure.
we're looking long term. I get that. The second thing is that with the private equity is how liquid is it to pull money out?
Similar to principal. It's like quarterly redemption.
Yeah, it's not gonna be a part of your portfolio that when we need money, that we're gonna.
Right. So, but my point, I guess what
I
I'm
mean-
getting at, we're at 6.8% now.
Yeah.
Right? If we put more money in it, we get to 7.5 or 8%.
Mhm.
In 2 years, we're sitting here and now we're at 11 or 12%.
Yeah.
Hopefully, I agree with you. I'm not saying, I'm not a huge fan of the whole thing, but I went along with it and that's
Sure,
fine.
sure.
But then we're scaling back. I'd rather we have organic growth on the private equity
Okay.
and pull back the real estate. That's, again, I'm one opinion of many, but I'd rather pull back the real estate and let the private equity organically grow, especially if we're looking at debt, bringing in a what kind of fund?
Private.
I'd say
Private-
that's
private-
probably
private
a while
credit.
from now, I would think.
Okay, but even that, because the other thing, which is a sidebar to this, is I think we ought to have somebody sort of project, we've had, obviously 2022 was really bad.
Mhm.
Right? And 2023 and 2024 were really, really good.
Mhm.
Our returns were not, large cap returns, but they were, but those were good. But we really haven't gained any ground as far as our total. I mean, we were at 25 million.
Yeah.
I forget what year it was, but then we just bumped up there and then we immediately came down. So what does this future look like if we continue to take money out at this rate and we have X amount of return? Will we ever get back to 25 million? Obviously, there's some projections and assumptions and all that kind of stuff. But, to talk about private credit and doing all kinds of other stuff, is it even in the cards? Because are we, and what kind of return do we need to, because we've had really good returns and over the
Yeah.
last 2 years and we really haven't gained that much ground, which is kind of scary.
I mean, yeah, page, I mean, we talk about it every time, but back in our main
know.
presentation, page 8 is, that's the battle that you've been fighting.
Yeah, yeah. So, so anyway, so that's my 5 cents
Let me ask.
about what it's worth.
Let me ask one question on private equity.
Mhm.
Is there a point in time, are there any cash calls that could be made on private equity from us?
What you would do, kind of the mechanism is you would, basically submit to Partners Group that you are looking to add funds. They're on a monthly basis on the info.
No, what I'm saying is, are there periods where they can make cash calls on us because of what?
It's a fund of.
No, no, I just want to.
Yeah, that's good. Yeah, it's not a closed
Okay,
end type
okay,
structure.
just wanna make
It's a
sure.
good question. Yeah, it's a
Yeah.
good
Yeah.
distinction.
It's very,
No, I mean, that's. I
Right.
definitely.
Where you're like, hey, I don't want to give you money. Like, no.
yeah, no, it's not a fund where they can,
Okay, that's
they
fine.
can,
Yeah, that's,
they're in money crunch and they can call and ask you.
Yeah.
So those are my thoughts as it's more of a planning and sort of looking
Mhm.
out instead of doing this as how we feel today.
I would typically, I would agree with that too, and I don't like the idea, and I'm a huge fan of Partners Group, but I don't want to put 10% in a single manager. If anything, I was hoping you had some other, or maybe you still
We do.
can, some other PE fund of fund options that
the 25 million,
is the cap.
that.
And that's why I want to see if we'll ever get there, but somebody to project. I don't know if you guys can do that or we can
I think
have
that would
somebody.
be actuary. Probably, 'cause
actuary.
They have access to obviously your actual data on cash
can-
flows. We just kind of see. the
I
investment
understand.
side of
No, I know.
things,
I didn't know
but
if you, yeah,
I would get AJ in there. do that.
maybe we'll hire Darren to do it. I'm just kidding, Darren. Yeah. Yeah, no, I know they can.
What specifically would you want the actuary to project?
Well, they can project what money's gonna come out
Looking at
in
cash flow,
future,
cash-
cash
Like a
flow.
Monte
You
Carlo.
want a cash flow?
Yeah, doing a cash flow because they know based on life expectancy and when people retire. So they can say, this is how much is gonna come out. And then if, they always project, what are they? They're projecting like an 8, they have to, like an 8% return. But I think based on
Hope not.
gap rules and all that, no, I think they do that, if I remember correctly, but is it 7.5? Okay, it's 7.5.
Mhm.
And then what we're putting in, which you guys kind of know versus, and then he could run it that, if you get a 6%, this is what it'll be. If you get your 7.5, this is what it'll be. Yeah, I mean, and sort of a year by year look at what it. Uh-huh. And we don't have to go out 20, 30 years. I mean, just for our purposes,
don't
maybe
care.
10 years, 15 years, just to see what it's look like. Because if the numbers show that we're going to be at 15 million in 5 years, it's
yeah.
it's a big,
Then we don't want to have 15% in illiquid funds either.
correct. Yeah. So.
So I have,
Yeah.
and I have two questions. Number one is, what's the impact going to be of freezing?
Your microphone, so.
What's the impact going to be of freezing the real estate taxes on us? Okay.
way one side, then there'll be no impact to our city, our income at all. But if it goes the other way where it doesn't apply, then it's really unclear to the 10 or 15%.
It might be that they have to, anybody over 62, they might have to kick out of the city.
Well, and then the other question is, at what point in time can we start looking at increasing property taxes to cover the pension plan? Because I think that would be the best thing to do. We don't necessarily have to go there, but we at least have that opportunity. Because as of right now, I think we're at the cap. Is that correct?
We were at 1. State law is 1.0. That's what the Constitution. We were above it. And got a blessing from the Attorney General, who said it was okay. We're now below 1 again, tax rate. So we had.
That's not our
We
committee.
go back up.
No, I like that. But I think, I mean, from a recommendation standpoint,
Well,
if
if
we
we-
find the cash flow is
Well,
not gonna
right.
be there,
That's a
I'd rather
really
get
good,
ahead of it.
but
as
that's
opposed to behind.
long deeper than I agree with you, but that's very deep because that, yeah. Right,
Well,
yeah,
in sales organization, you always have a revenue problem.
we've always been. All right, so back to square one.
Yeah.
I would be comfortable with doing the real estate at 5%.
Okay.
Not changing private equity at this time.
Okay.
And just giving ourselves bands. I don't know I don't know what our band is for the private equity.
Usually it's 5% either way. So right
Okay.
now, the 5% target, 1 or 0 and 10
Right.
and 10.
Um,
That's where it is now.
and I mean, if we want to, right now, I guess it's fine if we need to give ourselves more leeway and not pull money out, but as Mike said, I don't know if he wants to have 10% in
Not in
eventually.
a single manager anyway.
Yeah.
Yeah, that's obviously it's a very diversified company, fund, blah, blah, blah. But yeah, I mean, just to the point of having that in there.
Yeah.
Like I said, we haven't done that because you're this is like a trick bag here, because you're
Sure.
below that 25. When we did all this, you like crested over it. So that's why
Right,
we
that's
we jumped into it because like, we didn't know how long.
And it
Based on
wasn't
cash,
long.
based on cash flows.
We didn't stay there long.
So, but you're kind of grandfathered in.
Correct. So
So
that,
you're, sorry.
No, go ahead,
Finish that because
finish.
I'm going to a new thought.
oh,
on high-
no,
on the
so
high yield.
should we have a motion to do this?
You need a motion
That's
to give them a direction.
So I recommend
I move.
I move to change core real estate to 5%.
Okay.
Change the bands 5% on either side.
Yep.
And keep private equity the same. And you guys come back with a recommendation of where to increase the additional 5
Within the
within the,
other constraints of the.
yes.
Okay.
And my recommendation would be in the US equity markets and not the international markets.
Even though Europe's running this year so far, but it's a short
Got it.
year
Yeah,
against what we thought.
yes.
Okay.
You had asked the question about high yield. Is that to replace current high yield managers or was that in addition to the portfolio of high yield?
Replace current.
That would be a replacing what you currently have. So I ran some additional scenarios. Just looking at the cushion, because obviously that is a principal product. Your baseline right now cushion is 1.4 million. The rebalancing that we're gonna be proposing, just to, keep replenishing the kitty, gets your cushion back up to a little over 2 million. Obviously, very, very, very healthy. If you were to rebalance and completely remove high yield from your account principal, that would knock it down to about 1.2 million. So still healthy. Knocking real estate all the way down to 5%. I did like 10 different scenarios here. Rebalancing, getting rid of high yield, and real estate getting down to 5%, and your cushion is little under 800,000.
When you say get rid of high yield, you're saying high yield of principal?
I'm speaking
I
kind
ju- I
of
ju- I
casual
just wanna
here.
make sure.
I'm sorry, yeah.
So let me ask you a question, and we should probably go back to my motion and finish that, but I'm gonna,
Yes.
so we'll go this first. If we drop below our cushion.
Mhm.
Do they, I mean, they're monitoring this?
Well, the cushion is the additional part.
No, I understand. So we're under, so we have no cushion left. We're negative.
No,
No,
it's only if you drop below the cushion. The
Like,
cushion is the amount that you have
the
to have.
cushions
and I-
above
Not to get in trouble.
above here. This is the
Right,
trouble
right.
zone. Cushion's $1 million, right?
I understand. No,
Yeah.
I said that. If we lose that $1 million
Oh, okay.
Yes,
and we no longer have cushion,
then you know cushion, correct.
right?
You have to have communication.
Do they call you and say, you guys are below?
We haven't received that call in all our years, so that's a good thing. But what we do, like when markets were selling off, go back to
Right.
COVID, we're doing almost
Uh-huh.
weekly calls. Yeah, there was concerns, just kind of because you know, equity exposure and just trying to understand all that. So yeah, we're replenishing it if we need to. If there's like a major market meltdown, you need money to be able to cover that.
Right.
That is those are your benefits.
Correct. I mean, they're not going to call and shut us down immediately. My point is that
Yeah.
what, if we go to the 800, which you're recommending, or you're not, you're recommending, I'm not saying you recommend.
I
but-
will give you my full
Right,
recommendation is if you're willing to look at another high yield manager,
Mhm.
there's no rule you have to do all at one time.
Mhm.
So you find someone next meeting you like, you may pull half those assets out now, and then in a year, because each month, the amount you need to, to generate, it goes lower and lower. And we can look at then getting it all out within the course of a year. That's kind of like a middle ground. Then your cushion's still over $1 million. It's not less than $1 million. Real estate can come down. Everybody sleeps at night.
I think it's fine. Because I think we can always make adjustments if we,
'Cause you
we can
can.
always make adjustments if we have to.
You can. It's,
Yeah.
there's no.
Right.
Those are very liquid investments or mutual
Right.
funds we're talking about.
Correct. So, all right, so let me go back to my motion.
Are you wanting to amend your motion?
No, the motion's good. This is, the high yield is a totally different.
Okay.
Then we're gonna have to do a second motion for that.
That's fine.
Does everybody remember my motion?
Let me remind you.
Yeah, no, I remember it, but I just wanted to make sure everybody else was,
So he has asked that real estate be adjusted to 5%. He wants an adjustment on the bands, 5% on either side. Equity remains the same. And we've advised that Marquette will provide a recommendation on where to increase the other 5% at the next meeting.
Private equity says,
I'm sorry, that's what I meant.
Yes. Private equity remains the same. We'll have a recommendation for that additional 5% preferences. A little more
not
units
in.
there.
that was just a sidebar.
So you need a second, unless you want to change your motion.
No, that's fine.
Then you
That,
need a second.
yes,
That's good.
now we need a second.
Second.
Okay. Any discussion, questions? Anything? Okay, all in favor?
Aye.
All opposed? Anybody abstain? All right, so we got that. Now, you want us to do another motion regarding the high yield?
That would be another one if you're so inclined and we think that would be appropriate.
I mean, you're recommending that,
We are.
so I think we should do that.
Okay. Well,
That's
appreciate
that's
that.
why we hire you.
That's great. I appreciate that.
Getting back to discussion,
Yeah.
if we do pull, we have to go to the council to change the IPS, right?
Yes,
Yes.
So we won't be able to do this officially until we have a recommendation of where the 5% goes. Is that right?
Yes. That's true.
But we also won't know about when's the next redemption for principal?
It's quarterly. So it'd be, I don't know when the cutoff is, probably either April or July.
Is it's quarterly, so.
And what I've done for other clients that were kind of in between asset allocations is you can say, just skip us this time, next quarter. I'm
Yeah,
not saying to do that here, but it's flexible.
you can get that. Even if you're not paying.
which part? I'm sorry.
Partners group, private
No.
equity.
No.
Principal.
Oh,
Principal,
sorry.
with
Yeah.
you, the real estate, I think we should still go forward with that.
Yeah, I'm just saying,
Yeah.
like,
Yeah.
if you're between,
Yeah, we still have that 284,000 in the queue. To get down to 5%, you'd probably have to put in roughly about another 290, 289.
Where?
For principal, the redemption to get down to 5%.
Oh,
know we're not
gotcha.
doing- we're not
Yeah,
doing that
no,
now.
gotcha,
So you're talking
right.
about taking 5.7.
What,
So why don't you,
I suggest we do 2.5% of real estate to private equity. And then figure out the other 2.5%. Cause Partners Group is almost already there. It's at 6.8%.
well, but we've got a ban. We're gonna have a
Sure, sure,
ban
sure.
of,
But if we're changing the IPS,
so what do you, I'm not opposed. What do you,
I don't know if it's 2.5% to private equity and 2.5% to either fixed or
For you.
Or
oh,
US
I see what
equity.
you're saying.
Yeah.
so that we can go to the council and change the IPS.
Oh, yeah,
So
that's
now we
fine.
have the
That's fine.
10%.
Yeah, no, that's fine. Yeah, since we're there, unless all of a sudden principal goes down.
And and
I mean, not
now that,
principal,
now that it's, now
partners
that
goes
it's
down.
just 2.5, if that is the motion.
Mhm.
You know, knowing your weights and knowing the overall, you know, Russell 3000 weights. I would say that if 2.5% goes to private equity, I would just say 2.5% in the S&P 500. Because you were still a little bit underweight that.
That's fine.
Sure.
So if it was 5%, I'd be like, let's do the numbers just to make sure you're not getting out of whack, but 2.5%.
That's
That's
fine.
going, yes, so.
Okay,
we-
so I'll make a motion to,
Amend the motion.
should we amend the motion? Do you want to
Why-
amend the motion or do you want to make a new motion?
Why don't you make a new motion because you've already voted,
Right,
directing staff to, you can make the motion.
we can do it all in one, or you want to do, what would you like to do?
So
What's
I
easiest
think
for
based on the context of the conversation,
Mhm.
you can say that the pension board has reconsidered the direction to Marquette in the interim
Okay.
about their 5% recommendation. So in the interim, you want Marquette to take the 5% that they're eventually going to give you a recommendation on, and you want it to go 2.5% to private equity and 2.5%.
No, as far as we're gonna change the IPS.
Upon further discussion with
investment
Marquette,
pol-
we
yeah.
decided 2.5% would go to private equity to make it 7.5%, and 2.5% would go to US large cap.
Make your, there's your motion.
Okay.
There's your motion.
Do you want me to
Okay.
make it?
Yes,
Make a motion to, after discussion with Marquette, move the 5% that we're pulling from real estate, 2.5% would go to private equity and 2.5% would go to US large cap.
Nice second.
any discussion or comments or anything? Okay, all in favor?
Aye.
Any opposed? Super. All right. So we're good, right? Now we have to do the high yield.
Got to do high yield and then we're gonna need to raise some money.
Do we have to motion for, do you want to do them together? or
Let's
You
just
want,
do, no,
high yield.
let's do high yield first.
Okay.
Just authorize us to do high yield.
so we authorize Marquette based on their recommendation to start transferring money from a principal high yield fund into a, no?
To
Do a search.
perform a investment manager search at the next meeting that we will then present you multiple options and then the money will be later. But this is just saying, yes, Marquette, come back to the next meeting
Okay.
with a bunch of options.
With high yield options.
Yes.
Perfect. Do we have a second?
Second.
Perfect. Any discussions? All in favor?
Aye.
Any opposed? Awesome. Okay, now,
So, trying to balance what we've done.
Yeah.
If you go to exhibit 3, this is the one, it's kind of like a peach, I guess. It says
Yeah.
change. It says change fee target to 10%, which is not what we're doing, but
Mhm.
this helps get get some of the funds going here. One of the first things that we would need to do, so we have, if you go down to principal US property, see that is 5%. What we need to do, you have 284,000 that's in the exit queue. But in order to get to 5%, it's 573,000. So you would need to request more.
Is that possible?
Yeah, we have clients that have
Yeah.
different tranches effectively of exits and entries. So that would be something that we need to do today. Based on some of these changes here, so we don't want to add money to partners group. That one is out.
We probably don't want to pull as much from the S&P 500.
Yeah.
Yeah, so maybe just.
Do you want to,
Take that down.
can we do a general motion to let you guys go back?
That would be helpful. Yeah.
Yeah, why don't we do that? Because for you guys to do this on the fly and us, and then be committed to it is not good.
Yeah, okay.
So based on the two motions that were just approved, or actually the one, the original. We authorize Marquette based on the new percentages to reallocate the cash. To reallocate the cash and create enough for liquidity purposes,
Benefits, yeah.
based on the existing investments that we already, and put them and make the changes within the existing investments that we already have.
I second.
Any questions or comments? Perfect. All in favor?
Aye.
Any opposed? Perfect. Okay.
And the additional redemption for, so I don't know if we need to make that one special. The
For the real
redemption for
estate?
principal real estate.
I think we've already done that, isn't it?
Okay,
in
is
the
that
queue?
included?
Well, just the 280.
Yeah, but we needed a little bit more.
You need to,
You can bump it up
Need
by
to-
the-
We need to
to
go
get
up
down to
another
300.
300,000 or so.
so you're currently, you're 573,000 under the 5% target now.
So we authorize Marquette to make,
590 or 290.
to make the enough redemptions to get our allocation of real estate to 5% within the new within the new allocation
But I
that we
guess,
recommend,
yeah.
that within the investment policy statement. Second,
Second.
any discussion? Questions, anything? All in favor?
Aye.
Any opposed? Perfect. Okay, I'm worn out on emotion.
Yeah.
So we still need one more motion though to modify the bands, no?
No, that was part of mine. That was part of the
Okay.
original to modify.
I move that we.
No, we're good. I think we're good. Do you guys have anything else?
No, we have our marching orders.
Okay.
And
I move that we adjourn the meeting.
Not yet, not yet. I have one thing. I have one item.
Oh, what you want to?
And you guys can hang out for this if you want. So I have contacted a friend who used to work for the what's his name? I can't think of his, I just lost law firm. But anyway, I think we ought to pursue, and I'd like permission to pursue, he gave me some referrals to some attorneys to maybe look at our principal contract and see, I mean, we signed this thing 50 years ago and we're still fighting this 50 years later.
I move we take the Trump.
Yeah, we'll ask Trump to, not to have a motion, but just permission to go talk, to have some conversations with an attorney or something to see if we can do something about this contract. We did. Yeah, we did it with an ERISA attorney. Yeah, and I think we ought to look at somebody that does more litigation stuff. Because I think this is more about contracts than ERISA.
Let me take it to the council.
That's fine. Yeah, I
Uh,
didn't want to do anything without asking.
Yeah, let me take it to the council. What the council's gonna want to know is how much this individual may charge us.
This would just be an introductory, just to talk to them. There'd be no fees or anything like that unless they came back with a proposal.
Okay.
Yeah.
Yeah, let me take it to council.
That's fine.
Yep.
Yeah, that's, I didn't want to do anything till.
Yep.
But no, if there was any, if they said there's a fee to talk, then we're not talking.
Okay.
So,
What your grievances are about it, everything.
well, the grievance is what you just heard, which is we have to make our investment, our investment decisions because we have to keep so much in principle. And if we go below that number, the cushion. If we go below that and you don't change, then they will make everybody take an annuity. And the whole thing blows up and goes away.
And then any,
And-
any unfunded liability, the city still,
Right, so the city might have to pay $15 million for I don't know what the unfunded liability, but I know, Darren, do you know what the unfunded liability is currently? That's okay, but it's millions of dollars that that immediately would have to come up because they would mandate that everybody who's got a balance will turn their thing into an annuity.
You know, it's only those certain people that are guaranteed benefits that retire over 2,000. But
Yeah.
you're talking good terms.
Yeah, so it would be $10 million.
We would have to put a entire pension for that. Just those people that are just what they're holding up.
Yeah.
That's what they cover.
Right.
Right.
I mean, this is like, it's crazy. That- Yeah. Actually, it's 59 years old because that was the year I was born.
I mean, and that's when, you know, pension plans were the king.
Well,
Yeah.
before any retirement plan is allowed.
Right.
Right.
You shouldn't be able to, they shouldn't be
So-
able to hold you hostage.
The request of the board is to have a particular attorney that you know.
Yeah.
Take a look at the contract, like an introductory look. at the
Correct,
contract,
correct. Just to talk
Okay.
and see what they
What they think.
think.
Okay.
Correct. Yes. No, it's somebody who worked for Schlichter. That's what I was talking. Jerry Schlichter's the famous, but he was a partner with Jerry and he's no longer a partner with Jerry, but he gave me some names of attorneys to talk to. We'll see. Because as I said, I think it's a contract dispute. It's not a ERISA dispute. And we had an ERISA attorney look at it. And they said, no, it's falls under ERISA. Yeah, it does. But you shouldn't be able to be held hostage for 60 years.
Okay.
So anyway, that's my thoughts. And the last thing I will tell you is in 2009, I was not on this committee, but were you part of this in 2009?
Yes.
You were, and we lost a lot of money because we were handcuffed. We couldn't maneuver as far as investment returns. No. Yeah, so,
Are less tied to them than you were back then.
correct.
Right.
And equities, so.
Yeah.
As the fair market went, for the conscientious comfort. Get out of some of the more riskier assets, so that when markets do turn.
Yeah.
Take it on a chin.
Well, the cushion looks that much better.
Yeah.
Or cushion.
Correct.
Right.
Correct. So now your motion to adjourn,
Yes, I'd like.
I'll second.
meeting adjourned. Thank you, guys. Appreciate it. It was a good meeting.